Koppers' latest earnings report was a real nail-biter. On one hand, you had sales taking a hit, but on the other, management was just squeezing every last drop of profit out of the business. This tug-of-war sent the stock on an absolute roller coaster, and in this breakdown, we're going to get into exactly why.
So here's how we're going to tackle it. We'll start with the headline numbers that got everyone's attention. Then we'll dig into the real story behind the margins, look at management's game plan, see how the market reacted in real time, check out their guidance, and then I'll give you our final take on what to expect next.
All right, first up, the headline numbers. On the surface, this looked like a pretty clear-cut miss for Koppers, and it really set a negative tone right from the jump.
So the company posted what we on the street call a double miss. That means both revenue and their adjusted earnings per share came in below what analysts were expecting. And that revenue number, it was down over 12% from the same time last year. That's a pretty big drop. But here's where it gets really interesting. The stock actually jumped over 5% before the market even opened. And then it did a complete 180 and ended the day down more than 4%. So what on earth caused that wild swing? Well, the answer isn't in the headlines. You gotta dig a little deeper.
And that brings us right to the heart of the matter, the margin story. This is where that whole battle between profitability and weak demand really, really comes to life.
And wow, this table just says it all, doesn't it? I mean, look at this. Sales were down across every single one of their business segments. Performance chemicals got smacked particularly hard. But then you look over at the margins. Through some seriously aggressive cost cutting, two of those three segments, railroad products and carbon materials, actually improved their profitability compared to last year, even with less money coming in the door.
So how they do it? A huge piece of the puzzle was this big internal program they call Catalyst. Through that, they've managed to slash a whopping $19 million in administrative expenses so far this year. That right there, that's what got investors excited at first.
Okay, so what was management's story here? How did they explain this? Well, they pretty much framed this whole thing not as a problem, but as part of a very deliberate plan.
The CEO, Leroy Ball, was basically telling the market, hey, we're actively changing what this company is. The goal isn't just growth for growth's sake anymore. Nope. They're focusing on the parts of the business that make more money, need less cash to run, and are just, more reliable. It's all about controlling what you can control when the market's tough. And this isn't just talk either. They're putting their money where their mouth is. They've been trimming the fat, selling off a lower margin business, and closing down a volatile plant. They've also hit the brakes on spending and are funneling that cash right back to shareholders through a ton of stock buybacks and a nice steady dividend. Okay, so this brings us to the market's verdict. And what's so cool is that if you track the stock's price during the day, you can literally see investors trying to figure out this puzzle in real time. I mean, the day started with a bang. The stock popped because investors saw the cost savings and breathed a sigh of relief. But then the 11 a.m. conference call started, and as management kept talking, the mood shifted. The focus turned to just how weak sales really were, especially in that performance chemicals segment. And by the end of the day, the fear about slowing growth completely overpowered the excitement about cost control.
So, looking forward, what did management have to say? Well, their updated forecast for the full year pretty much perfectly captures this strategic trade-off they're making. They took their sales forecast down, basically admitting that things are pretty soft out there. But, and this is the crucial part, they held the line on their profit targets. The message they're sending is crystal clear. Yeah, sales will be down about 10% this year, but we're still going to make just as much money as we did last year.
All right, let's put it all together. It's time for our take. Here's what we think is coming next quarter, what it means for the stock, and what our final rating is.
So here's the bottom line. We fully expect Koppers to hit their profit numbers for Q4. That Catalyst program is for real. But the stock? It's probably going to be stuck in neutral for a while. The market is basically waiting for proof that demand is coming back before it gets excited again. Until that happens, it's just a stalemate, which leads us to a market perform reading.
So with a stock that's kind of stuck in this tug of war, is there even a trade to be made? Well, let's see what some traders are thinking.
It's pretty interesting, actually. If you look at the options market after the earnings report, you see a decent amount of action in the December $25 calls. That tells us that some people out there are betting that if management just keeps executing on these margins, the stock could be set up for a nice rebound as we head into 2026, even if sales are weak for a little while longer.
This is not financial advice.